To all my prudent savers out there, I dare I say Christmas has come early again. The Federal Reserve has increased the interest rate, the federal funds rate, for the 10th consecutive time in a row since last March. So what this basically means is a handful of things. Number one, the Federal Reserve does not believe the fight against inflation is complete. That battle is won. They also feel like the economy is still able to sustain higher interest rates in its fight against inflation. So a couple key takeaways from this video as far as the update with the Federal Reserve with the federal rate hikes. Number one, we are gonna have to see if the Federal Reserve is pushing its luck with the rate hikes. I am in total agreement that the inflation problem is arguably the bigger issue if you have to pick between inflation and a dragging economy. But that having been said, a very good point was brought up by another financial professional in the YouTube space, Clear Value Tax, in his video and his coverage of the federal rate hike. He brought up a good point that I was thinking the same thing when I saw the Federal Reserve has already predicted that there will likely be a 1% increase in unemployment from about 3.5 or 3.6 right now to about 4.5 by the end of the year, which is equated to about 1 million or million plus jobs. They've also priced in that they expect the economy to be officially in recession by the end of 2023. So the point that was made, and the point that I also have to substantiate in this video, is will the fight on inflation be complete by the time the economy slumps into an official recession? If it's not, we have a major problem on our hands here in the United States economically. And the reason for that is going to be simple. If the Federal Reserve is not completing this fight against inflation, then that basically means that they would technically need to keep rates high to continue to compress interest rates. Doing so, unfortunately, is also going to compress an already depressed economy. You cannot fight inflation and support a dragging economy at the same time. The Federal Reserve is not capable of doing that. It's two different tool sets. So what that basically means is if by the end of the year, if inflation is not down to 2%, as the Federal Reserve's target rate, and we are in a full-blown recession, the Federal Reserve will have a very tough decision to make, tougher than it's already been for them, which has not been an easy job. The Federal Reserve will be forced to pick between persistent inflation and a stagnating economy. Now, the Federal Reserve's ability to stimulate the economy is powerful. The problem is doing so will automatically increase inflation because you have to bring down interest rates to stimulate lending. So lending stimulates borrowing, borrowing stimulates spending, and this is how the economy gets into motion. Unfortunately, that exact cycle is what puts inflation into overdrive. So we'll have to wait and see how the third and fourth quarter shake out. We'll have to see how the data comes out for the second quarter. First quarter GDP dropped significantly below what most economists and analysts were projecting. And with that being the case, then now you have to concern yourself with the second quarter being equally as bad or worse than the first quarter was. So if that's the case and we're precipitously declining in our economic production, and the Federal Reserve is still in this fight against inflation, then we'll have to see how the Federal Reserve can handle what's called, economically speaking, stagflation, which is a stagnant economy during inflationary times. So if that transpires, we'll have to see what the Federal Reserve and the federal government decide to do. For you out there, economically, what does that look like for you? Well, if the Federal Reserve is forced to continue to keep interest rates up and they don't pivot and cut rates prematurely sometime this year, and we are officially in recession, then you're going to have to make a decision, because you're going to have to figure out, we all are going to have to figure out, where's the best place for our money to go in a time frame where inflation is bad, but the economy is depressed at the same time. So the key point in this video that I wanted to bring up, and I hinted at it in the beginning of the video, savers are gonna win at this point in time. For the first time in a very long time, we're in an economic cycle where the interest rates are actually competitive or exceeding inflationary rates. The headline inflation rate, of course, not every single inflationary metric in the basket. What that basically means, and what I'm trying to get through in this video really quickly before we close out, is right now deposit accounts and prudent saving is the winner right now. If you have an effective stock market strategy, that's great. If you have an effective real estate strategy, that's great. But if you're not in one of those spaces, already doing really well with a proven business model or investment strategy, and you have cash, you have excess capital, then that basically means that your only true sensible safe haven right now is to not get caught up in spending, keep your debt to a bare minimum to zero if possible, and to save prudently. There are very attractive high yield savings accounts available. There are many different institutions, and there are very attractive CD rates also available. And this is going to be the safest, most effective, and competitive place for you to put your money for the foreseeable future, for the rest of 2023, possibly. So I wanted to bring this to you guys. You know, if you're following financial content, I'm not breaking anything new about the Federal Reserve raising rates. You already know that happened. What I wanted to bring to you was a different perspective that I wasn't seeing too much of in the media, and that was that savers are winning right now. And yes, there's a lot of losses. But again, if you have cash and you're not already stuck in investing, or, you know, have a persistent strategy going on right now, then saving is an effective strategy right now. And it's going to be for the foreseeable future. So short-term CDs and high-yield savings accounts are the winner. You want to check with your local bank, you know, whoever you have a strong relationship with, wherever your capital's put up. Look at 3, 6, and 9 month options on CDs that are at 3, 4, and 5%. High-yield savings accounts that are in the 3.5% to 4.5% range, so on and so forth. You want to exercise these rates while they're here, because they won't be here forever. The economy that we're going into, the economic times we're going into, are going to be relatively historic in the next 6 to 12 months. And I'm not sure if these deposit rates are going to hold up through that economic cycle. So this is what I wanted to bring to you guys for now. I wanted to bring this immediate update. This is being shot relatively live and going to be uploaded very quickly. You know, I hope you guys are in position, and if you're not, prioritize your credit, minimize your debt, and build up your cash reserves and your savings, and don't do anything crazy. Business-wise, don't quit jobs that you don't have to quit. Stability is supreme right now. Savings, stability is supreme right now. The risk taking this isn't the time for it. So thank y'all for tuning in. I know this information was valuable for you. I enjoyed bringing it to you out here on this beautiful evening. I hope you guys have a great rest of your evening, or what day or whatever time frame you catch this. As always, to all my pioneers out there, I want you to stay focused, stay in motion. I'll see y'all soon. This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.